They wanted a silent night. The bankers on Wall Street wanted to close their books early, head home to their families, and let the markets sleep until the new year. December 24th is traditionally the quietest trading day of the calendar. Volume drops to a whisper. Desks sit empty. Nothing of consequence happens. But on this particular Christmas Eve, the market had different plans. At 9:30 a.m. Eastern Time, when the opening bell rang, something unusual began to unfold. Silver, the metal that industrial manufacturers depend on and investors have quietly accumulated for months, started moving. Not the gentle drift that characterizes holiday trading, but a violent surge that caught nearly everyone off guard. By mid-session, silver was trading at $72.42 per ounce. This represented a gain of nearly $4 in a single day, a move of 5.6% in one session. In the normally stable precious metals market, this was not a rally. This was a rupture. The question that immediately formed in the minds of experienced traders was simple. Why today? Why would such an explosive move happen on the day when most professionals had already mentally checked out for the holidays? The answer lies in something most people never consider. Risk management protocols. Consider the position of a risk manager at a major commercial bank. This individual oversees a book of derivatives, futures contracts, and short positions worth hundreds of millions of dollars. For months, the bank has held a massive short position in silver. They have been betting that the price would fall, or at least remain contained, but the price has not cooperated. It broke through $70 just days earlier. Now the bank sits underwater on those positions, watching losses accumulate with each uptick in price. Now add the holiday factor. The markets will close for Christmas. They will remain closed while the world continues to turn. News can break, geopolitical events can unfold, supply disruptions can materialize. If a risk manager goes into a multi-day market closure holding a massive short position, and adverse news hits during that closure, the bank could wake up on Friday morning facing catastrophic losses. The risk is unacceptable, so the risk manager makes a decision. He taps the trader on the shoulder and delivers a simple instruction. Get us out. Close the positions. The price does not matter. The priority is to enter the holiday weekend flat, with no exposure, no risk, no chance of a disaster unfolding while everyone is away from their desks. This creates what market participants call forced liquidation. The bank is not buying silver because they believe in its long-term value. They are not purchasing because their analysts predict higher prices. They are buying purely because they are terrified of holding a short position while the market is closed. This is panic buying in its purest form, driven not by opportunity but by fear. When this buying pressure hits a market that is already thin due to holiday absences, the effect is dramatic. There are fewer participants, fewer market makers providing liquidity, fewer counterparties willing to take the other side of trades. Each buy order has an outsized impact. The price does not climb steadily. It teleports upward in chunks, jumping from 69 to 72.42 in what appears to be a single vertical move on the chart. This is the air pocket that technical analysts reference. In that moment, there were no sellers at rational price levels. There were only desperate institutions trying to exit the building before the doors locked for the holiday. Every trader knows that the worst time to need liquidity is when nobody else is around to provide it. Christmas Eve is that moment crystallized. But the silver move, as dramatic as it was, tells only part of the story. Simultaneously, gold reached a level that carries enormous symbolic and practical significance. Gold touched $4,500 per ounce. For those who understand monetary history, this number is not just a price. It is a signal. Gold serves as the master clock of the financial system, the reference point against which all fiat currencies are ultimately measured. When gold reaches $4,500, it is communicating something profound about the purchasing power of the dollar. It indicates that the currency is losing ground, that the policies of central banks, the expansion of money supply, the accumulation of sovereign debt, all of these factors are eroding the value of paper money. Investors are fleeing into hard assets. They are seeking protection. And when gold sends this signal, silver inevitably follows. The mathematical relationship between these two metals cannot be ignored. The gold to silver ratio currently stands at approximately 62 to 1. This means it takes 62 ounces of silver to purchase 1 ounce of gold. Historically, this ratio has been much tighter. In 1980, during the last major precious metals boom, the ratio compressed to 17 to 1. In 2011, it reached 30 to 1. Even at $72 per ounce, silver remains undervalued relative to its larger counterpart. The banks know this. The algorithms that drive institutional trading know this. And on this Christmas Eve, with gold breaking out and silver still lagging, the mathematical imperative became clear. Silver had to catch up. The rubber band had stretched too far, and when it snapped back, it moved with the violence that only forced buying can create. The trading floors had gone quiet. There exists a relationship between gold and silver that has persisted for centuries. It is not a legal mandate. No government enforces it. No regulatory body monitors it. Yet it governs the behavior of these two metals with a consistency that borders on the mechanical. Traders call it the gold to silver ratio, and on this particular day, that ratio was screaming a message that sophisticated market participants could not ignore. The calculation is straightforward. Take the price of gold and divide it by the price of silver. On December 24th, that equation produced a result of 62. This means an investor needed to exchange 62 ounces of silver to acquire a single ounce of gold. To the casual observer, this might seem like arbitrary trivia. To those who study market history, it represents a massive distortion that cannot persist indefinitely. Rewind to 1980. The Hunt brothers, two Texas billionaires, had attempted to corner the silver market. Prices had exploded. In that environment of maximum speculation and mania, the gold to silver ratio compressed to 17 to 1. Silver had become extraordinarily valuable relative to gold. The ratio reflected the fever pitch of that particular moment in financial history. Fast forward to 2011. The global financial crisis had shaken confidence in paper assets. Quantitative easing programs were flooding the system with newly created currency. Investors fled to precious metals as a refuge. During that flight to safety, the ratio tightened to 30 to 1. Again, silver had closed the gap with its more prestigious counterpart. Now examine the present. At 62 to 1, silver is trading at a significant discount compared to these historical episodes. But the discount becomes even more pronounced when measured against deeper history. For thousands of years, across multiple civilizations, the ratio held near 15 to 1. The Romans maintained it around that level. Medieval Europe saw similar dynamics. Even the United States, when it operated under a bimetallic standard, legally defined the ratio at 15 to 1. Why does this mathematical relationship persist across such vast stretches of time and geography? The answer lies in geology and industrial reality. Silver and gold emerge from the earth at roughly that proportion. For every ounce of gold mined, approximately 15 to 20 ounces of silver come out of the ground. Nature has established a ratio, and while speculation can push market prices away from that natural equilibrium, gravity eventually reasserts itself. At $4,500 gold and a 62 to 1 ratio, silver at $72 represents a profound undervaluation. If the ratio were to revert to just 30 to 1, not the extreme compression of 17 to 1, but the more moderate level seen in 2011, the mathematics become impossible to ignore. Divide $4,500 by 30. The result is $150 per ounce for silver. That represents more than a doubling from current levels. The algorithmic trading systems that now dominate modern markets operate on precisely this kind of mathematical relationship. These systems do not experience fear or greed. They do not take vacations. They monitor correlations, identify discrepancies, and execute trades when statistical anomalies reach sufficient magnitude. When gold broke through $4,500 on Christmas Eve, every quantitative model watching the precious metals space registered the same alert. Silver was lagging. The spread had widened beyond normal parameters. Opportunity had emerged. This explains the ferocity of the move to $72 and $40. It was not primarily retail investors buying coins and bars. It was not television pundits recommending precious metals to their audiences. It was systematic strategies, operated by major funds and institutional desks, recognizing a mathematical imperative and acting on it with the cold efficiency that characterizes machine-driven trading. But algorithms operate on more than just historical ratios. They also monitor momentum. They track the rate of change. They identify acceleration. And in the silver market, acceleration had reached levels that trigger a specific category of programmed response. When an asset moves 5.6% in a single session, particularly in a market known for stability, the systems interpret this as a regime change. The asset is no longer trading in a range. It is broken out. And breakouts, once confirmed, attract additional capital through momentum strategies. These momentum systems do not ask why the price is rising. They do not care about the fundamental story. They simply recognize that something is moving with unusual velocity and position themselves accordingly. This creates a secondary wave of buying that amplifies the initial move. The short covering that began the rally attracts momentum capital, which pushes prices higher, which triggers additional momentum strategies, which creates a self-reinforcing cycle. The industrial consumers of silver were watching this unfold with growing concern. Silver is not simply an investment vehicle. It is a critical industrial input. Electronics manufacturers require it for circuit boards. Solar panel producers need it for photovoltaic cells. Medical device companies use it for antimicrobial properties. These businesses operate on tight margins. A doubling in the price of a key input material represents an existential threat to profitability. In the trading rooms of Lower Manhattan, a peculiar silence had settled over the derivatives desks. The violent surge to $72.42 was not merely a price movement. It was a confession. After months of defending their short positions, after countless meetings with risk committees, after reassuring senior management that the situation remained under control, the commercial banks had been forced to admit defeat. But the true danger was only beginning to reveal itself. Short squeezes do not announce themselves with press releases. There's no official declaration that marks the transition from orderly market to forced liquidation. Instead, traders learn to read the signatures hidden within the price action itself. Speed is the first indicator. When silver moved 5.6% in a single session during what should have been the sleepiest trading day of the year, it left a fingerprint that professionals recognized immediately. This was not the gradual accumulation of patient investors building positions over weeks. This was the mathematical signature of panic. Organic buying moves like water flowing downhill. It follows the path of least resistance. It accumulates gradually as investors research, deliberate, and deploy capital in measured increments. A healthy bull market might see gains of 1 or 2% per session, compounding over months into substantial returns. But a short squeeze moves like a lightning strike, vertical, instantaneous, violent. It represents sellers transforming into buyers, not by choice, but by necessity. The mechanics of this transformation reveal the fragility embedded within the modern financial system. Consider a bank that entered short positions when silver traded at $65. They believed the price was elevated and would decline. They sold futures contracts, collected premiums, and waited for gravity to pull prices lower. But gravity failed to cooperate. Instead, silver climbed to $68, then $70, then broke through to $72. With each dollar of upward movement, the bank's losses mounted. At a certain threshold of pain, predetermined by risk management systems and regulatory capital requirements, the position becomes untenable. The bank receives a margin call. They must either post additional collateral to maintain the short position or close it out by buying back the contracts they had sold. During normal market conditions, this process unfolds in an orderly fashion. Market makers provide liquidity, counterparties step in, the exit happens with minimal market impact. But Christmas Eve was not normal market conditions. The liquidity providers had gone home, the market makers had reduced their exposure, the counterparties were skiing in Aspen or celebrating with family in Connecticut. When the banks needed to buy, there was nobody standing ready to sell at reasonable prices. Each buy order had to reach further up the order book, hitting progressively higher ask prices, pushing the market upward in a self-reinforcing spiral. This creates what engineers would recognize as a positive feedback loop. In stable systems, negative feedback loops dominate. When a price rises too high, buyers pull back and sellers emerge, naturally constraining the move. But in a short squeeze, the mechanism inverts. Rising prices inflict pain on short sellers. That pain forces them to buy. Their buying pushes prices higher. Higher prices inflict more pain. More pain forces more buying. The loop feeds on itself, accelerating with each iteration, until either the shorts are completely eliminated or the market finds a source of supply substantial enough to absorb the forced buying. The banks trapped in these positions face a cruel mathematical reality. They cannot simply decide to wait it out. Unlike a long position, which can be held indefinitely in the hope that prices eventually recover, a short position carries theoretically unlimited risk. If a trader buys silver at $70 and the price falls to $50, the maximum loss is $70 per ounce. The trader cannot lose more than their initial investment. But if a trader shorts silver at $70 and the price rises to $100, then $150, then $200, the losses continue to mount with no ceiling. This asymmetry explains why short squeezes generate such extraordinary volatility. The question that haunted risk managers during the Christmas holiday was deceptively simple. Where does it stop? The banks had attempted to defend the $70 level. They had failed. They tried to contain the move at $72. That line had also been breached. If institutional selling could not stop the advance at these levels, what price would finally bring out enough supply to halt the squeeze? Some analysts pointed to $75 as a potential resistance zone. Others suggested $80, a psychological milestone that would attract profit-taking from early buyers. The more pessimistic voices whispered about $100, a level not seen since the brief spike 4 decades earlier. But the honest answer was that nobody knew. In a genuine short squeeze, price discovery fails. The normal mechanisms that establish fair value break down. The market trades not on fundamentals, but on the desperation of trapped participants. Beyond the immediate price action, a more fundamental shift was occurring in market psychology. For years, $70 silver had existed as a theoretical ceiling. Analysts would construct their models, investors would set their targets, and the number $70 hovered in the collective consciousness as an upper boundary. Breaking through that barrier accomplished more than just triggering stop-loss orders. It shattered a belief system. The markets had closed. Christmas Day arrived with its traditional silence. Families gathered. Offices sat empty. The trading screens went dark. But beneath the surface calm, a dangerous divergence was opening between two worlds that are supposed to mirror each other. The paper market and the physical market were beginning to tell contradictory stories. In the realm of futures contracts and electronic trading, silver carried a price of $72.42. This number flickered across Bloomberg terminals and financial websites. It represented the theoretical value at which market participants could exchange contracts for future delivery. But theory and reality were drifting apart in ways that would have profound implications when trading resumed. Across the globe, bullion dealers were making quiet decisions that received no media coverage. Shop owners in Vienna checked their inventory levels and made calls to their suppliers. Mints in Perth, Australia ran calculations on their production capacity versus incoming orders. Refineries in Switzerland that transform raw silver into investment-grade bars assessed their stockpiles. And many of them reached the same conclusion. They would not be opening their doors at normal capacity when the holiday ended. This was not a coordinated conspiracy. No secret meetings occurred. No cartel issued instructions. Instead, it was the rational response of individuals looking at their own specific circumstances. A dealer who purchased inventory at $68 per ounce and now faced a spot price of $72 understood basic mathematics. If they sold their existing stock at current prices, they would realize a profit, but replacing that inventory at $72 to serve future customers would consume that profit immediately. Worse, if prices continued to climb, they could find themselves in a position where they had sold at $70 but needed to replenish at $78 or $82. The solution was simple self-preservation. Raise premiums above spot price, extend delivery times, limit order sizes, or simply close temporarily and claim holiday staffing challenges. Each dealer acting in their own interest created a collective outcome. The physical market was seizing up precisely when the paper market was signaling abundant supply at $72.42. This divergence revealed something fundamental about the architecture of modern precious metals markets. The vast majority of trading occurs not in physical metal, but in paper contracts. Futures exchanges, options markets, and exchange-traded funds dominate the volume statistics. On any given day, the notional value of silver contracts traded might exceed the entire above-ground supply of physical silver multiple times over. This system functions smoothly when confidence remains high. Participants trust that paper claims can be converted into metal if necessary. But when that trust fractures, even slightly, the mechanism breaks down. Professional traders have a term for the period between December 26th and January 1st. They call it the ghost week. It is a strange interlude where markets technically remain open, but operate with a fraction of normal participation. The senior executives are absent. The experienced risk managers are unavailable. The sophisticated liquidity providers have reduced their exposure to minimal levels. What remains is a skeleton crew of junior traders, automated algorithms, and a handful of speculators willing to operate in what amounts to a financial no man's land. History has demonstrated repeatedly that this ghost week can produce some of the most extreme price movements of the entire year. The 1994 peso crisis erupted during this period. The 2018 flash crash in the Japanese yen occurred in these dead days between Christmas and New Year. When liquidity evaporates and unexpected news hits, markets can gap violently in either direction. The normal shock absorbers that dampen volatility simply do not exist. For silver, entering this ghost week at 72.42 with a confirmed short squeeze underway created a particularly unstable configuration. The shorts, who had been forced to cover on Christmas Eve, represented only one category of market participant. Others remained trapped: regional banks with smaller derivative books, manufacturing companies that had hedged their input costs, mining companies that had forward sold their production at lower prices. Each of these entities faced their own calculations about whether to exit positions during the ghost week or wait until normal liquidity returned in January. The order books told the story with brutal clarity. Under normal conditions, a trader looking to buy or sell 10,000 ounces of silver might see continuous pricing with tight spreads. Bid and ask prices separated by pennies. But during the ghost week, those order books transformed into something resembling a minefield. A bid at 72.40 might be followed by nothing until 72.80, then a gap to 73.50. The absence of market makers meant that any sizable order would walk up or down the price ladder, creating the appearance of massive moves that reflected nothing more than an absence of liquidity. This created opportunity and danger in equal measure. A trader with the right positioning could execute a relatively small order and watch the price jump $2 or $3 simply because there was nobody standing in between the current price and the next available liquidity. But that same dynamic meant that anyone needing to exit a position urgently could face catastrophic execution. A market order to sell could hit bids dollars below the displayed price, turning what appeared to be a profitable position into a losing one in seconds. The physical disconnect added another dimension to this already volatile situation. Investors watching silver trade at $72 on their screens might attempt to convert paper profits into physical metal, only to discover that dealers were quoting $78 or $80 for actual delivery,